For 2026, the IRS has increased the contribution limits for the health savings account, allowing individuals to shield more income from taxes than ever before. Yet millions of Americans leave these funds unused because they follow the standard cycle of spending the balance on immediate doctor visits. Capitalizing on these new 2026 limits requires a shift in how you handle medical expenses. Instead of using the account as a short-term payment tool, you can manage it as a long-term investment vehicle. To implement this, we are building a physical tracking system. This is the 2026 HSA Stealth Strategy Portfolio. It is a papercraft tool designed to organize your specific financial targets and physically archive your medical documentation. You will need a few supplies to complete the project. Gather 2 sheets of heavy paper, a pair of scissors, tape, and a marker. Before we begin the first fold, check your insurance status. Participation in an HSA requires active enrollment in a qualifying High Deductible Health Plan, and you cannot be enrolled in Medicare or claimed as a dependent. This physical portfolio creates a barrier between your medical bills and your HSA balance. By treating the account as a dedicated investment, you allow the funds to grow under 3 distinct tax advantages that are not available in any other single U.S. account. Take your first sheet of heavy paper and lay it flat. Fold it into perfect thirds, like a standard business letter. Each section of this fold represents a specific tax benefit. This diagram shows the page divided into 3 panels. The top fold represents the first advantage. Contributions are tax deductible. If you use payroll deductions, the money is moved pre-tax, which reduces your taxable income for the current year. The middle fold represents the second advantage. Once inside the account, your balance grows tax-free. Whether the money is in a cash account or invested in the market, you owe no taxes on the capital gains or interest earned. The bottom fold represents the final advantage. When you withdraw funds for qualified medical expenses, the transaction is entirely tax-free. No other retirement account, neither the 401k nor the Roth IRA, offers all 3 of these benefits simultaneously. This triple tax advantage allows the HSA to function as a highly efficient retirement tool for those who can afford to pay their current medical bills out of pocket and let the account compound. To ensure your balance remains untouched, we will create a storage area. Apply double-sided tape strictly to the outer left and right edges of the bottom third. Press it shut against the middle section to form a pocket. Label this the receipt vault. Most users deplete their HSA balance every year on minor copays and prescriptions. By paying those costs with your regular checking account instead, you keep your HSA funds available for long-term growth. This works because of the delayed reimbursement rule. The IRS allows you to reimburse yourself tax-free for a medical expense years or even decades after it happened. As long as you have the documentation and the expense occurred after you open the HSA, the withdrawal remains tax-free. Test the pocket now by sliding in a piece of scrap paper. Ensure the tape holds firmly so your documentation is secure. Physically hoarding your receipts in this vault allows your digital HSA balance to remain in the market. This maximizes the time your money spends in the tax-free growth phase. To track your progress toward the new IRS maximums, cut a contrasting rectangle from your second sheet of paper. Slide it into the top fold of your portfolio to act as a tracker card. Your contribution limit depends on your plan type. As this chart shows, individuals with self-only HDHPP coverage can contribute up to $4,400 in 2026. Write this number at the top of your tracker card. Those with family coverage can contribute up to $8,750. If you are 55 or older, you can add an additional $1,000 catch-up contribution. Record the limit that applies to your household. Finally, cut a small paper tab, write "Invested" on it, and tape it to the front cover. Contributing the maximum amount is only the first step. To see significant growth, you must log into your provider portal and move your balance out of the default cash holding and into mutual funds or ETFs. Maxing out the slider and moving the funds into investments is what changes the HSA from a simple healthcare bucket into a long-term wealth-building account. Your portfolio is now active. When you confirm a new contribution from your paycheck, slide your tracker card upward to record the progress toward your 2026 goal. The next time you have a medical bill, pay it with your standard funds. Take the receipt, fold it, and slide it into the vault. By age 65, your invested balance will have benefited from years of tax-free compounding. At that point, the rules change. You can withdraw the money for any non-medical reason without penalty. These withdrawals are simply taxed as ordinary income, mirroring the treatment of a 401k. To begin, log into your employer's benefits portal today. Adjust your 2026 payroll elections to reach the new contribution limit you have recorded on your tracker. This 10-minute project provides the physical framework needed to follow the delayed reimbursement strategy. It turns a misunderstood tax code provision into a clear, manageable path toward decades of untaxed growth.